So a question I get asked a lot is how do I go about selecting hard money lenders? In my experience with hard money lenders, majority of the time they'll all advertise their interest rates. But what I tell people is dive a little deeper than just looking at their interest rates and trying to decide somebody based off that interest rate. So the interest rates they typically range somewhere between 8 to 15%. With that's a pretty large scale, but that 8% typically you're either putting more money down, you're more experienced, or you have really good credit. Whereas the higher end of that scale, either you're less experienced, poor credit score, or it's like 100% financing. So depending on what you're looking for, it's gonna vary somewhere along that scale, but typically somewhere between 8 to 15% interest is what you can expect to pay for hard money. Then you have points. Typically, you'll go anywhere from 2 to 5 points, but once again, that varies based on credit, experience, and then also how much you're borrowing. So that may vary. The next thing I tell people to look at is then look at your terms, because typically I've seen somewhere between 6, 9, 12-month terms. You can have some, I've even seen 18-month terms offered, but those terms, they vary from lender to lender, and that's just lender specific. So I tell people a 6-month term is really hard on people, just because I tell people always, especially if it's a flip, budget 3 months for rehab, 3 months to sell a property. Because most sellers, they're always asking for at least 45 days. So hopefully, your property is on the market less than 30 days, but that 45-day mark, it should definitely be gone, especially in this good market. So with that 3 month for sales, 3 months for rehab, that's 6 months total. So if you only have 6 months, then what happens is you have to pay an extension fee to extend it past that, even if, let's say, your deal's going to close in month 7. So you always want to try to get a longer term. To me, that's just necessary, because it takes some of that pressure off of you. And what happens after you go through your qualifications, you have the property that you want the bank to lend on. Once you submit it to them, they'll give you what's called a term sheet or a deal sheet, and that deal sheet is negotiable. It'll tell you what your rate is, what your term is, and that's all negotiable. So definitely negotiate that. After that, then you start to look at the fee structure of getting the money. So you'll have, is there an application fee? Is there an inspection fee? What other fees are added on that's going to be costing you extra money? So that's something that you want to look at also when you're comparing companies, to make sure you're really comparing apples to apples. After those fees, the next thing I tell people to look for is how do they charge interest? Is interest accrued based on money that's withdrawn, or is interest accrued based on the entire loan amount from day one? So obviously, what you don't want to do is have interest accrued based on the total loan amount from day one if you don't have all that money withdrawn at the same time, because you'll just be paying a higher amount in interest every month. So that's something that you want to look for. My preference is to work with those lenders that interest accrues as it's drawn on the loan, meaning from day one, the only interest that's accrued is whatever the hard money lender had to put out for me to purchase the property. And then as I take my first draw, then that money gets added to the interest accrued. So that way I'm paying less in interest as the project goes along, as opposed to having to pay interest based on the full amount from day one. So then after that, I'll then look and see, okay, how long does it take for the lender to actually give you a draw? Sometimes that may or may not be discussed or disclosed, or the lender may tell you one thing that may not necessarily be true. So obviously, the faster you submit a draw, they come out, do the inspection, and give you your money, the better for you, because that way you can continue your project moving. So typically for me, 2 days is great. 3 days is okay. But I've seen lenders take as long as or I've also experienced lenders take as long as a week and a half. So what that does is, if you're waiting on that draw money to then do the next phase of your project, that's now extending your project. If it's a week, and you're doing 3 or 4 draws typically, by 3 extra weeks to 4.5 weeks, which is an extra month, and now you have to make a separate monthly payment for just waiting on the money for your draws. You're making an extra mortgage payment, so that's something that you have to be cognizant of. And then after that, what I also like to look for is just the knowledge of the market. So you have different lenders that they can be local or they can be national. What I've experienced are the people that are local have an actual knowledge of the market, and as you're explaining it to them, they may not necessarily ask you for as much paperwork, as much documentation, and the ease of things just goes a lot smoother because they have that knowledge of market versus a national lender that has no clue, no idea about your market. It may be a little bit harder. They may not necessarily like the market as much, so they may do a lower loan to value. So you may end up coming more out of pocket. So those are just all things to look at and consider when evaluating hard money lenders, to make sure that you're choosing the best one that works for your situation. Once again, ultimately, it's about the relationship that you make with them. So once again, that relationship is key. It's a people business. And as a bonus one, the one thing also that people don't sometimes take into account is this person a direct lender or are they a broker? Direct lenders are always great to work with because they control their money sources and they control who they lend to. So therefore, if you're in a pinch and you have a good relationship with a direct lender, you can potentially get that money versus a broker who, they may not necessarily have a lender that's then going to go out on a limb for you. However, brokers are still useful because depending on what your profile, what your makeup is as an investor, as a developer, brokers have a lot of contacts with multiple banks, so they have multiple programs that they can potentially slot you into. So they can typically, shop you around to those different hard money lenders, and then find somebody that's willing to work with your profile. So that's also something good to know. Is this lender, are they a direct lender or are they just a broker? So that way you can adjust and operate accordingly. But that's essentially hard money demystified. Like I said, there's a lot that comes at you. A lot of people just want to go based off of solely the rates. Oh, well, this person said I can get an 8% versus a 10% or versus a 12%. But it's just diving deeper than that to see, okay, well, is that 8%? How does that stack up when you compare everything across the line to maybe that 12% or that 10%? How does everything compare? Because those are all things, as you work with different lenders, as you get experience, that at the end of the day, those are all things that matter. So 9 times out of 10, the one that offers the lowest rate may not necessarily be the best one package-wise. So you have to look at hard money lenders and evaluate the total package that they offer and not just the interest rate that they're charging you. Because once again, they can charge you a low interest rate, but you can be paying based off of your total loan amount the entire life of the loan, versus somebody that may charge you a higher interest rate, but then you're paying only on interest drawn. So it's just something for you to evaluate to see what makes sense for you as you run your business. Hopefully it helped. If you found any value in this, please don't be afraid to like, share, or comment. If you have any questions, definitely please ask. Until next time.